For this week, we're going to be in chapters 5 and 6 in our textbook. And for chapter 5, we're going to be starting off with just talking about banking in general and interest rates associated with that. Now, there's many kinds of financial institutions that are out here, and Exhibit 5.1 here just shows the basic categories of financial institutions. And let me just briefly mention those financial institutions in case you're not familiar with them. The first one is what are called depository institutions. And these are financial institutions that accept deposits from individuals and provide loans. These are the ones that most of you are aware of. These are, the Wells Fargos, the B of A's, those kinds of things. These are banks primarily. They do commercial loans. They accept deposits. They use those funds to provide commercial and personal loans to others. These organizations, the deposits that we put in there are insured by the FDIC, the Federal Deposit Insurance Corporation, for deposits up to $250,000 per depositor. There's also savings institutions or thrift institutions, sometimes they're referred to, which are financial institutions that accept deposits and provide mortgage and personal loans to individuals. There's credit unions, which are nonprofit depository institutions that serve members who have a common affiliation. There's what's called non-depository institutions, which are financial institutions that do not offer FDIC insured balances, but provide various other financial services. A lot of these are finance companies that specialize in providing personal loans to individuals. There's also security firms that are out there that are financial institutions. These are non-depository institutions that facilitate the purchase or sale of securities by providing investment banking and brokerage services. There's insurance companies that are out there. These are also non-depository institutions that provide insurance to protect individuals or firms against possible adverse effects. There's investment companies that are out there, which are also non-depository institutions that sell shares to individuals. They use the proceeds to invest in securities to create mutual funds out there. And then there's also financial conglomerates that we'll see a lot of these things all put together. These are financial institutions that offer a diverse set of financial services to individuals or firms. And really, financial conglomerates, I mentioned B of A before, but B of A does have its banking side, but it also is a conglomerate where it does all of these other things also. And Citigroup is also another one. As we begin to look at these financial institutions, it's important to understand that how to select a financial institution. Obviously, when we're talking about selecting a financial institution, you're going to be looking at certain things like the checking services that are provided. And of course, a checking account, just so that you understand what a checking account is if you do not have one, it allows you to draw funds on your cash that you have put with that bank. And it's used, of course, to pay bills on time. And banks will typically issue what's called a debit card, which is merely another way of taking out immediately that cash that's in your account. Mobile banking is something that you're starting to see more and more of coming into existence, where you are using online to access your account. And of course, all of these things, whether it's online banking, whether it's going into an ATM, it's actually physically going into a bank itself, it's important for you to monitor your account balance and to reconcile your account balance and to always know what is in your account. So as you start to look at selecting a financial institution, a couple of the terms, before we actually look at the criteria itself, a couple of the terms that I want you to be aware of is terms such as check float. And what check float is the time from when you write a check until your checking account is actually reduced for that amount. And for example, you may actually write a check on the first of the month, but the bank receives that check on the first of the month, but the bank may not actually process that check until the second of the month, which means in essence you need to understand that if you were to, at the end of day one on the first of the month, go in and look at the balance on your ATM, it may not reflect that amount of the check. That is called float itself. There's also other services that are provided, which financing services like credit cards. Credit cards obviously is financing where you put the purchase on a credit card and you don't have to pay for that purchase until later on in the billing cycle of that credit card. Debit cards are like a credit card, but they instantly come out of your checking account. And it's debit cards are quite often are much better for teenagers to be using because parents can, in essence, put funds into an account, and a teenager can learn how to manage their personal financial assets by using a debit card. And when the money runs out, that's it. They're not able to purchase anymore, where you can get in trouble with a credit card itself. Some of the other services that a financial institution might provide include safety deposit boxes, of course, where you as a customer can store documents or jewelry or other valuables. They, of course, will provide ATMs where you can withdraw money or you can make deposits. They'll provide something called a cashier's check. What a cashier's check is that is just a check that is written on behalf of a person to a specific payee, and it's going to be charged against that financial institution's account. So quite often when you're going and doing a major transaction, for example, maybe purchasing a car, and you're going to be writing a check, the dealership may insist on a cashier's check versus a personal check, because a cashier's check is the check is already or the bank has already guaranteed that those funds are available, and those funds in essence have been removed from the account. A money order is something that is a check that is written on behalf of a person for a fixed amount that is paid in advance. There's also something called a traveler's check, which you are seeing used less and less, but they still are used out there. That is a check that is written on behalf of an individual, and it's going to be charged against a large, well-known financial institution or credit card sponsor's account. And this is used quite often by people who travel to places where they do not want to carry that cash, or they're not quite sure that a credit card is going to be actually accepted there. So let's talk about selecting a financial institution itself. What are some of the criteria that you're going to use? Well, obviously, the convenience is a real factor. If you want to be with a bank, you want to be close to where you live or work, ATMs that are accessible, the ability to have online banking. You may find it very important, depending upon your personal situation, to be able to pay bills online. You're going to be interested, of course, in if you're going to be having savings there, what kind of savings rates you're going to be getting, whether it's insured or not insured by FDIC. What are some fees that the bank may be charging? All of these things are things that you need to be very aware of as you go into any decision that you make, because you can find quite a bit of difference from institution to institution. So as we begin to look at, let's understand interests that you can actually earn and receive on deposits and on loans, and how that all works. Interest rates on deposits and loans, of course, affect your cash inflows and your outflows. And just a couple of definitions, terms here. A certificate of deposit, or CD, is an instrument that is issued by a depository institution, and it specifies a minimum investment, an interest rate, and a maturity. For example, you might go and purchase at your bank a certificate of deposit, a 90-day CD or longer. And what you'll be doing is you'll be taking a set dollar amount, let's say $10,000, and the bank will quote you and say, if you put $10,000 into this CD, you will get this percentage of interest, or this is what you will get at the end of those 90 days. You'll also hear a term called risk-free rate, which is a return on investment that is guaranteed for a specific period. On CDs, those are considered risk-free rates. is when they quote you a particular rate, this isn't subject to what else is happening in the economy. This is what you are going to be receiving back, assuming the bank doesn't go out of business, which is usually a fairly low risk. There's also something termed that's called risk premium. And this is an additional return beyond the risk-free rate that can be earned from a deposit guaranteed by the government. And so these will be, with respect to certain kinds of investments that you might make that are a little riskier investments that people usually at higher income levels will be involved in. There's also what's called the loan rate, which is what the bank or other financial institution is going to loan money to you. It is at a rate higher than they paid depositors. So the way banks work is you may be putting your money in the bank. You may put $10,000 in the bank, and you may earn 1% on that. But then they turn around and take that $10,000 and they loan it out to other people, and they charge 5% on that. And the difference between the 5% that they're charging somebody else and the 1% they're paying you, that's how they make a profit. And the amount that they are loaning out is those interest rates will vary, because people who have a poor credit history, they're going to pay higher rates because there's a higher risk of default on the bank itself. That is what is called a risk premium that they're going to be involved with. So this, again, going back to that risk premium, is they're going to assess the risk on a loan, and depending upon the risk, is they're going to either charge a lower interest rate or a higher interest rate to loan you that money. Now, the economy is just important to understand the impact of the economy on risk premiums itself, because when economic conditions in the economy weaken, firms issuing securities must pay a higher risk premium to sell their securities, resulting obviously in investors' reluctance to purchase securities for fear that the firm might go bankrupt or might not repay their debt. So investors are much more willing to come into the market in a favorable economic environment or climate. So just understanding how the economy can impact interest rates. Sometimes it's also, just so that you understand, there can be a twisted perspective on risk premiums, because some investors are attracted to investments for the wrong reasons. They might pursue risky investments to make up for limited income. It's almost like gambling out there. And this is faulty reasoning when you talk about risk premiums, because usually those with limited incomes, they can less afford to incur or absorb those losses. I mean, it really does become like gambling. So when you're going out there and you're shopping for interest rates, either interest rates that you're going to receive or interest rates that you're going to pay, understand that the choices that are out there are really being driven by risk tolerance on the other side. If you need your money within a year and you're making investment decisions, you really should be taking no risk. Or if you cannot afford to absorb any losses, you should be taking no risk. You will need a portion of your money, especially within the 12-month period, when your investment matures. And if you don't need the money until then, you can afford to take a little bit more risk. So there is no such thing as the right choice for all investors. Every investor needs to make individual decisions on that. And that's how interest rates then are structured themselves. The shifts in the yield curve, just so that you understand, because the text will make reference to this, and they'll make reference to yield curves, and don't get too caught up in all of the mathematics that's going on behind the yield curves itself. But those things, again, is you can always go out and do, whether it's the Wall Street Journal or other places, go out and do research on those kinds of things. So let's talk about why interest rates change in the economy, and how the Fed can get involved. Interest rates basically are impacted by Fed policy, monetary policy itself. And it's the actions that are taken by the Federal Reserve to control the money supply, whether it's expanding or contracting. And the money supply is really being driven by demand deposits, from, which are primarily checking accounts, and currency held by the public. There's also open market operations where the Fed out there is buying or selling treasury securities to, in essence, also impact the money supply itself. So why do interest rates change? Well, there's shift in the government demand for funds, where any change in the government's borrowing behavior can affect the demand for funds and affect interest rates. There's also shift in business demands for funds, when firms adjust their borrowings and spending plans, that affects the demand and for interest, the demand for funds. And so all of these things the Fed will use to stimulate the economy, which will then have an impact on interest rates themselves. And so the question really comes down to, how can interest rates really and business services impact your financial plan? Well, obviously, you're going to be looking at what kind of banking service characteristics are most important to you, and different people may have different things that are important to them, and what financial institution really provides the best banking characteristic for you or your business itself. Now, as we look at Chapter 6 and getting into managing your money, this now really starts to get into an emphasis on really liquidity and managing your personal liquidity itself. And it's the whole area called money management, which money management is simply the decisions that are made over a short term regarding cash inflows and cash outflows. And when we use the term liquidity, it's just your ability to cover any cash deficiencies that may occur, or your ability to get cash inflows to manage whatever is directly necessary for you as an individual on your personal cash statement, or you as a business on your business cash statement. And quite often people will start to use credit cards for liquidity to try to make up for those short-term differences. Understand that credit cards themselves, and we get into this much more in detail in the personal finance class, but for credit cards themselves, the interest rates are usually very, very high, usually in the 14 to 24% category. And maintaining adequate liquid assets really does allow you to avoid using credit card, avoid paying those kind of exorbitant finance charges that can come through on that. So when we talk about liquidity, I want to talk now from the investment side of things, which is really talking about money markets. And money markets is basically talking about those kinds of liquid assets that allow you to manage your personal liquid position so that you don't have to resort to high cost type of borrowing, such as credit cards, to make up for that. And obviously the most common money market investment that's out there is your checking account. Probably one that's even more liquid than that is the cash that you stuck in your mattress. But we're going to assume that you practice a little better money management than that. So you have a checking account. This is what is considered a very liquid investment. You may have overdraft protection with your checking account. That's an arrangement that you have with the bank. So if you accidentally write a check for an amount that exceeds the amount that's in your checking account balance, it's overdraft protection is actually a short-term loan from the bank to cover that amount. It may save on overdraft fees and bounced checks, but obviously that overdraft protection may come with a cost itself. There's something called a stop payment that also may be out there with respect to on your money, on your liquid checking account itself, your money market investment. And that's a stop payment is just the ability to say, wow, I wrote a check to somebody and now I don't want that check to be honored. So now you go to the bank and they basically will stop the payment. So if that check gets processed, it will not get, or if it gets received, it will not get processed to your account. Other things that checking accounts can do to manage your money is provide for direct deposits. Obviously there are fees associated with most of these kinds of transactions. However, this is part of the importance of shopping around with banks, because banks may give you a break on those fees depending upon what kind of customer you are, how much money you may have. For most checking accounts, the most liquid investment, you do not receive any interest income on that. There's another kind of money market investment out there beyond your checking account. Is called a NOW account, or NOW, and that's just a negotiable order of withdrawal account. It's a type of deposit offered by depository institutions that provide checking services, pay interest. Usually these accounts require a minimum balance. Quite often there's a limit on the number of transactions that you can process through this account. It's a little less liquid, but it's also then allows you to manage your account a little bit better. Another kind of account that's even a little less liquid than that, but it's still pretty liquid, is a savings account that pays interest. They're usually a little less liquid than checking accounts because you actually have to go and do a separate transaction to be able to access that savings account, because you don't have a check that you're able to immediately write for that. Kind of moving up the scale, the liquidity scale, is your next less liquid but still relatively liquid money market investment, is a certificate of deposit. Certificate of deposits, you have your retail CDs that are out there that have small denominations, usually $10,000. And these CDs, the advantage of CDs is they pay a little higher interest rate than your savings account. They're a little less liquid because these have terms associated with them, and it's quite often if you need to, in essence, withdraw from a CD before its maturity date, there's usually penalties that are imposed for those early withdrawals. Moving up the score of the less liquid but still considered a money market investment would be your money market deposit accounts, your MMDAs. These are deposits that are offered by depository institutions, again, that require a minimum balance. They usually have no maturity date, but they pay interest out there, and these will allow a limited number of checks to be written every month. These are less liquid than your checking accounts, but they will pay a higher interest rate. Many people will keep a checking or a NOW account for the day-to-day, and they begin to keep a money market account, money market deposit account for other kinds of funds. Moving up the less liquid but higher interest is you get to Treasury securities, which are just debt securities issued by the U.S. Treasury. There's T-bills that are out there, which are Treasury securities with maturities of 1 year or less. Again, these have a return that's associated with them, a rate of return, and when you actually these things mature, it actually results in capital gains. So you then fall under capital gains treatments. There could be there's a secondary market out there for these kind of T-bills, where if you want to cash out of that T-bill, you can actually go out and purchase. You can sell them, or you can purchase from others who are looking at cashing out. And usually the quotations for those things can be found out there online or in financial news publications. There's also what's called a money market fund, which are accounts that pool money from individuals and they invest in securities that have short-term maturity. These money market funds typically are less than 90 days, and quite often they're involved in purchasing commercial paper that's out there, which is short-term securities that are issued by large corporations, like a General Motors or those kind of large corporations that may offer a slightly higher return than Treasury bills. And again, you can also find quotations for those things that are out there. So I want to talk about, I've kind of talked in general about all of those money market type of investments, but let's just talk about risks associated with money market investments, because obviously whenever you're involved in money market investments, there are risks. Whether it's a checking account, those risks may be relatively low, or you're getting more into T-bills or money market funds, the risks can go up there. And so, there's all sorts of risks. There's obviously a credit risk of default that a borrower may or may not repay on a timely basis. Obviously, if you are invested in T-bills, there is a risk that the feds could go bankrupt. But the feds kind of have a way of kind of kicking the ball down the street, so to speak. And so the likelihood of them going bankrupt next month or in the next 3 months is relatively low. But if you were investing in something that it was 20 years down the road, you may have a little higher concern. There's risks of default associated with virtually any company out there. There's also interest rate risks, there's a risk that the value of an investment could decline as a result of a change in interest rate, especially if you're involved in something like corporate bonds. There's a liquidity risk that you may not be able to, for certain kinds of investments that you have, you may not be able to convert them to cash quite as quickly as you wanted to. There's also the risk from just the economic conditions on liquidity needs, obviously. If there's a strong economy, that strong economy means there's better job opportunities and income is more secure. And so there's less reliance on those funds to cover expenses. And if there's a weak economy, of course, you have the exact opposite kind of possibility where funds are just not being allocated out there. You always have to, whenever you're making investment decisions, whenever you are, in essence, managing your money market itself, you have to always consider the risk return trade-off before you make the investment decisions. Most money market instruments are largely free from credit risk. Most of them. Not all of them. But things like, as we talked about before, as you kind of move up the ladder on the less liquidity, higher return, the one that I talked about last were money market funds. They do carry more credit risk than your checking account, since they hold commercial paper itself. So you always want to determine the optimal allocation of what your money market investments are going to be. You want to anticipate, whether it's personally or for a business, you want to anticipate what your upcoming bills are, what your upcoming needs are going to be, so that you have adequate funds in the most liquid of your accounts to be able to address those things. You also want to estimate additional funds you may need in the near future and invest that in a little more of a liquid investment. And if there are funds that are necessary or needed longer term, they can be in a less liquid investment that maybe carry a higher return. Again, it's going to be driven by your risk tolerance itself. Recently, as we all know, interest rates on money market investments have been low, very low. But we need to be careful that we resist the temptation to reduce those kind of investments in favor of stocks that may give us a higher rate of return if we have liquid needs, if we have where we have a risk tolerance that is very low. So what's the optimum allocation? Well, you kind of look at this chart here, and this really kind of gives you just a sense for how you may allocate your investment depending upon your anticipated expenses. If you have net cash flows who needs a who needs a lot of liquidity because of your needs that are coming up, then you're going to want to allocate most of your investments to liquid funds. to be able to cover those anticipated expenses. If you have non-liquid funds, you don't have needs, then you may have less that you're going to allocate to non-liquid funds, which you can afford to put in longer-term investments. Those longer-term investments, again, are going to be made based upon your risk tolerance, what your risk premiums are. And conversely, if you have very little liquidity, you may decide to invest in longer term investments, less liquid funds themselves. So again, understanding the basic terminology, understanding the options out there become an integral part of your money management financial plan, whether as an individual or as a business, especially if it's your own small business. Next week, we'll be starting on chapters 7 and 8.